You're listening to Sprott Money's Monthly Wrap-Up with Craig Hemke.
Well, hello again from Sprott Money News and SprottMoney.com. It's late May 2022, so it's time for your monthly wrap-up. I'm your host, Craig Hemke, and joining us this month is Tavi Costa. Tavi, an old friend of ours who is a partner and portfolio manager with Crescat Capital in Denver. It's going to be great to get his input on all that has taken place this month and begin to look ahead to June. Before we get there, though, please remember that this content is brought to you by SprottMoney.com. Anytime you are in the market for physical precious metal or looking for a place to store it, SprottMoney.com needs to be your number one go-to site. All kinds of great deals, always competitive pricing, SprottMoney.com, or you can call them at 888-861-0775. Okay, let's get this underway. Tavi, thank you for spending a few minutes with me.
Hey, Craig, thanks for having me again. Looking forward to this.
This has been a doozy, though, of a month, Tavi.
Mm-hmm.
So I got to get your thoughts first and foremost on what we've dealt with over the last, really 5 or 6 weeks now. I think it was the Monday after Easter that gold briefly traded above 2,000 and silver traded up near 27. And then it was straight down the elevator shaft for about 5 weeks in a row. What do you make of that? And you might just throw in about, from a macro sense, what your firm makes of all that.
Yeah, it's been, as you said, it's been kind of chaotic with what's happening with the markets as a whole. I would say there's some sort of a liquidation that happened in the markets with even more of the unfolding of this problems that we've seen with long duration assets and technology companies, and really the capital outflows from things that have been crowded over the years to things that are really unloved, which are, in my view, tangible assets. And so that rotation continues to happen. But recently, the steep decline in equity markets caused some liquidation in some folks in other portfolios. And I think there's a lot going on under the hood in markets. Crypto assets have really plunged in the last weeks or so. We've had a few cryptocurrencies actually going to zero, which is a little bit of a reminder of risk and management in general for some folks. And but it's it's a good reminder of when cost of capital rises is folks have to do fundamental analysis. We're back to that, which we saw that back in the 90s, maybe. Yep. Mid 2000s, and I think most market participants have forgotten how to behave in this environment. But profitability is back. And Craig, if you look at the markets right now, the sector that is really lagging is not even technology. We saw the technology lagging period all the way back to 2021 February. And now I think what's really lagging is actually consumer discretionary. Guess why? Because it's the squeeze of margins is real. And those are the businesses that have some of the lowest margins in the whole overall market right now. And so we're seeing profitability becoming a priority again, as we thought it would. And so therefore we're seeing some of those companies with very lean margins having issues now. So.
Well, let's talk about that as it relates to the mining sector, Tavi, about margins getting squeezed with input costs for miners going up so much, diesel fuel, energy, the rest. And a lot of the majors pointing that out with their last round of earnings results, talking about, oh man, our all-in sustaining costs are going up and we're getting squeezed in all these different directions. You've been a big proponent of the shares and how they're finally spitting off free cash flow and that sort of thing. How aggressively do you factor in inflation, that sort of thing, and how you guys evaluate mining companies that you want to invest in?
Yeah, some of the producers certainly have been impacted negatively with their margins too. But I would say at least their products and what their underlying commodity that they sell is moving in the right direction. Even though gold and silver may not be going up as much as we thought it would, at least it's not going down like technology stocks are in the last in the last few months. And so I think there's more of an intellectual arbitrage when you think about what's happening in commodities, just for the fact that there's a lack of knowledge in the space, creating a lot of inefficiencies. When you look at the free cash flow in aggregate for the miners, it's quite interesting. There is a little bit of a divergence with where gold prices are versus where free cash flow is, meaning free cash flow is not following as strong as actually gold prices are when you look on a monthly basis or quarterly basis. However, it's not really as significant as you're seeing in other parts of the market. And so that should still, I think the overall equity market will suffer, including mining stocks when it comes to margins. But I think that those the mining space is certainly should be favored, considering the fact that we're holding tangible assets, and the issues on supply should continue to lead to higher prices of those businesses. And so, it's been a lot of negative with pessimism in general for the industry, but I don't think things have really changed as far as the thesis remains as strong as it gets. And I think investors, it's a time to get busy and accumulate assets as much as you can in the space. That's my view, at least. But I think fundamentals continue to look really strong. Energy companies, free cash flow yields for energy companies, despite the recent appreciation in price of those stocks, look really, really strong. I mean, it's probably one of the strongest free cash flow yields we've seen in history. And so commodities still look very attractive. And I think that's a real trend. I posted a chart recently of commodities versus NASDAQ. And NASDAQ is now decoupling from commodities, or commodities are decoupling from NASDAQ, where NASDAQ is starting to fall as commodities are up almost 180% all the way back to the pre-highs of the pandemic in February 19. And you're looking at NASDAQ now, there's a separation of over 50 percentage points between the two asset classes. And so quite interesting what's going on.
You mentioned commodities, Tavi, and so many base metals have had such a strong 18 to 24 months. But silver really hasn't, and I know that weighs on a lot of silver investors' minds because it's been a really sideways 10 years, I guess, at this point. I did a thing, one of the features that we do every month here at Sprott Money is Ask the Expert. And the expert here in May from a couple of weeks ago was Frank Justra. And one of the questions somebody had sent in for Frank, I think I just maybe prompted this in my head that I'd ask you this too, because the question that was for Frank was, if silver can't keep up with inflation, then how can silver mining companies expect to perform long term? If they're constantly getting squeezed in their margins, if their output of their what they produce isn't keeping up with inflation, then their costs are just going to keep rising faster than their product. What do you think of that? Do we need, obviously higher metal prices are always going to help, but is that particular in the commodity story that, since silver's performed so poorly for years, that it maybe other more base metal mining or gold metal mining is a better place to look?
Well, it's an interesting question because it's a self-fulfilling prophecy at the same time. As monetary conditions tighten here, it should also hurt a lot of the producers to continue to produce. And so at some point, it should lead to even lower supply and more constrained supply that should increase the pressure towards the appreciation of those commodities. I mean, I've been also very surprised with the price of silver. But I should point out that the goal for an investor is to identify long-term trends and accumulate assets prior to the move. And what I think it's interesting here is we've had the same case for energy, let's say. If you look at oil, for instance, back in 2020, the case for oil was just as strong as the case for silver is today. The thing is, there was a trigger at that time, many triggers. Some of them, the Green Revolution started to really move forward, and we had the election, which shifted leadership in the U.S., and we had the oil prices going negative, and some companies went bankrupt during that time. And so there was some sort of trigger that caused the beginning of a bull market for oil. I don't know, as an investor, it's just very, very difficult and challenging to have that crystal ball to figure out what the trigger is. I have some ideas what it could be. It could be yield curve control. It could be a reversal of the Fed policy. I mean, it could be so many things. Now, what I do think is it's going to look obvious when silver, in my view, gets up to, let's say, $50 an ounce or so. I think a lot of people will look back and say, yeah, that was very obvious that this was a very strong case and you should be buying it. But unfortunately, markets don't behave that way. They stay irrational for sometimes longer than it deserves, and perhaps a lot of market participants end up not really finding those inefficiencies as opportunities. And so as I said, our goal is to get as close as we can to identifying those long-term trends. And I think we identify one here. I mean, it's monetary asset at a time of inflation, when I think over history, certainly it's behaved very well. It certainly served as a hedge to inflation and performed better than gold during those times too. Gold to silver ratio looks extremely attractive for silver right now. We know the supply side is very constrained and mostly comes from countries that have a lot of geopolitical issues. And so it's historically undervalued relative to equities and gold, as I said before, the monetary base relative to other commodities. And so the case is very, very strong. The CapEx for the silver miners have been dismal over the years. You look at the discoveries of silver has been very low also. And so it's, we aggregate the whole thesis. It looks really attractive. Who knows what the trigger is going to be? But I think as an investor, you want to be a buyer, not staying in the sidelines.
Do you think, I guess I do, that we're headed toward what I call Powell pivot number 2, being that Powell pivot number 1 was when the equity markets crashed about 20% in the fourth quarter of 18. All of a sudden they went from tightening to loosening. Will it take a kind of a max pain environment again for equity investors to get to Powell pivot 2?
I think it's going to take a little more pain. I think it's interesting what's going on, because we're looking kind of backwards on things, particularly the Federal Reserve, and you think about just in terms of earnings. Earnings are at peak right now, but are they really? Realistically, in the next 6 months, I don't think they're going to be at peak at all. I think they're going to be much lower. We're seeing margin squeezes everywhere, as I was referring to before. Labor markets. What does it mean that technology companies are, behaving very poorly in the last month or so? I mean, technology is a major part of the economy today. It's also a major part of labor. So, what does it mean to unemployment rates in the near future? So, I think there are a lot of questions when it comes to the macro data that's going to be coming out in the next 6 to 9 months. That we could be, very well in a recession already. I'm in that camp, but the Fed is always late to the party. It might tighten monetary conditions even further. Some folks are worried that this is going to hit the commodities market. If it does, what an opportunity! But in my view, the availability of capital is one of the most important themes here, and that is going away. That availability, the excessive liquidity that we've had over the years, and the lack of discipline. It's almost like we have to go a little bit to a more disciplined world, very different than we've seen the progressively more aggressive monetary and fiscal policy over the last 20 to 30 years. And so it's, I personally think that at some point we'll see 10-year yields is starting to bother some of the Fed members, and we may see some sort of yield curve control, or at least an attempt to that. And so I've been in that camp. But I think we're going to see more pain in equity markets before the Fed really reverses its policy.
Well, let's finish with that question then, I guess, Tavi. If as we look ahead now to June, May obviously being was a pretty challenging month. You had the May FOMC meeting about 3 weeks ago that kind of laid out this course of 50 basis points for next several meetings in a row. What will you look for, do you think, to sense that, okay, the worst is over, at least for the metals? Will it be a turn of the bond market, turn of the dollar index, economic data? What will we be watching here in the month of June to kind of give you a feel that things are turning for us?
Well, look, the short answer is I don't have that clarity as much as I wish I had. One thing I am looking at, and I never stop looking at, is if the macro thesis continues to be strong. And if I continue to identify that the long-term trends are still as appealing as they were before, I think there's a lot of mining companies that kind of missed their window to raise capital. And so you've had companies now having to raise money at a much lower valuations, which the market is not going to treat well, most of those companies. And so it's a great opportunity to find great assets for companies to still hold great assets. They just missed the window to raise capital. And so as an investor, I think you should be taking advantage of those opportunities going forward. As far as any market signal, look, some of the signals that I think are important is that we just had one of the largest tax revenues in history of the U.S. In the last 12 months. And mostly that has to do with what the government was handing out of cash to the population. And basically everything went up. And we saw a debasement of the currency in 2021 relative to other assets. And then folks had to pay some of their share in terms of taxes. So majority of that came from individual taxes here. And so I think you got to be watching for what's the next development, and the next development is going to be fiscal spending, and fiscal spending is really, really strong, more than we've seen any other time outside of recessionary periods. Even adjusted for inflation, what we're spending when it comes to fiscal stimulus is absurd, and that to me is that fiscal and monetary disorder is what leads to folks starting to buy monetary metals and over time. And so now that's what I'm paying very close attention to. I think that any reversal in policy making, I think, would start leading to potential rising in metal prices. I think the 60-40 portfolios and the unwinding of those portfolios and starting to really look into other or new ways of hedging their portfolios. I think gold is going to play a role into that, just like other commodities have done recently. And so, yeah, it's hard to pinpoint one or two or three things that can make the shift on to a full-blown bull market for precious metals. But the long-term case is really strong. And so I think investors should just lean on that part of it and really continue to accumulate as much as possible. At least that has been our approach towards this.
Right. So Tavi, before we go, tell everybody a little bit about Crescat Capital. I am a happy customer / client, but rather than me do the commercial, you tell everybody what you guys do out there in Denver.
Oh, and we're very appreciative of having you as a client, by the way. We manage a global macro hedge fund, which has been doing very well this year. I think we're up about 40% year to date. Long short as well is another fund that we manage. The precious metals fund we launched back in August of 2020. It's done very well over since its inception. I believe we're up about maybe closer to 200% or so since inception. And our goal is really to invest in what we think it's going to be this exploration age, Craig. I think we're going to see the comeback of this exploration budget from the majors and other companies in order to replenish their reserves. And I think there's going to be an M&A cycle that we've never seen in the past. I mean, we've seen M&A cycles in the past, but I think this is going to be to a degree that we have not seen over the last few decades. And so I'm extremely excited. I think you want to own high quality assets in the space. And our goal is to be lead investors of most of those deals that we believe are going to be world-class discoveries.
Yep. All right. And one more thing before we go, just the reminder I like to leave everybody with. Of course, this content just doesn't appear from nowhere. Someone has to sponsor it, and their sponsor is Sprott Money. So do a couple of things for them. One, at least just give them a like or a subscribe on whatever channel you're listening to this, or the monthly or the Ask the Expert segment, or the monthly precious metals projections, all the other great content that Sprott Money puts out. If you just give them a like or a subscribe, that helps get the cast the net a little wider and get the word out. But also, anytime you're in the market to buy yourself some physical precious metal, again, everything's on sale at this point. Make sure you stop by sprottmoney.com. They always have great deals on precious metal, but also storage of that precious metal. All the deals are on the website, sprottmoney.com. But of course, you want to just pick up the phone and give them a call. They'll be happy to help you at 888-861-0775. We've been speaking with Tavi Costa, portfolio manager and partner at Crescat Capital. Great voice of in the precious metals industry, and great to get his perspective here in May. Tavi, thank you so much for your time.
Thank you, Craig. Appreciate it.
From all of us here at sprottmoney.com, thank you for listening. We'll have more content for you next month.